So this is volumes around the world, full year volume. So 2018, you can see, was a little bit higher than 17. In fact, technically it was the third highest on record in the decade that we've been tracking the globe. I think we talked to a lot of people. They didn't feel like it was like the third best year ever, but it was on a global basis. This is just income-producing property. It does not include sales of land and dev sites, which were considerable, especially in China. China, developers paid, I don't have final stats, but somewhere between 400 and 500 billion just for land rights there. So still considerable activity in China on the development side. Most of the energy this past year was in the US. You can see the darker blue, America's bar, much greater than it was the year before. Asia Pac was relatively flat, and decline seen in Europe. So, you can actually kind of see, 15, and we had Brexit. People were kind of forgotten about Brexit or waiting to see what happens, and there's a little more energy. 17 was a good year there, even though it was down quite a bit in the US. It kind of flip-flopped. So as Brexit, I believe, came closer and other issues, we've started to see volumes decline. And we really, particularly in the fourth quarter, which we'll talk about. Another big trend in the marketplace have been these big mega deals, large, huge portfolio transactions and entity deals. Logistics, retail, hotel were kind of the epicenter of many of these transactions. And it kind of obscures some of the trends. I usually take them out when I look at what the underlying trend is and look at the sale of individual assets. So in Europe, there's some huge portfolio deals in the prior year. So the declines we saw in Europe were actually not so great if you just look at the underlying single asset market, but that was compounded by much greater declines because of fewer portfolio deals. In APAC, a huge surge, 49% increase in portfolio and entity deals, which offset their weakness in the single asset market. So overall, APAC was flat. And then in the Americas, we were up in the high single digits, but again, another almost 40% increase year over year in these big portfolio and entity deals. Added sparkle. This language came from my colleagues in London, so they have more colorful language than I would use. And I'm not even sure flattered, or I can't even say it, is a word. But I figured I don't know, is always that a word?
I'd say flat.
Well, whatever. Yeah, if we were playing, I would, Scrabble, I'd challenge it. So overall, that's we were slightly up, even though the underlying market slightly down. But if you go back, it's been relatively similar place. 2015 was the benchmark. I would say at the end of 2015, there's definitely more fear that things were getting a little too heated, and the market's backed off. We are seeing resistance to higher prices around the globe. That's one commonality. We did see price appreciation slow considerably this year, but it was overall positive. On a macro basis, I will say here in New York, we saw a little bit of a price correction, probably 25, 30 basis points, but the market started to move again. All of a sudden, just took a little bit of a price correction for transactions to reinvigorate. So this is, I love bubble graphs, and I think you can get a lot of information. So year-over-year change in investment is here on the x-axis, so everything to the right of the zero had a positive year. But the fourth quarter changes in volume is on the y-axis. So everything below this line had a really weak fourth quarter. So you can see, even though the overall stats are fairly positive, there are a lot of markets that had a negative year, both the overall trend and the most recent trend. I mean, Japan is a big surprise, especially in the quarter, a 60% decline in the fourth quarter. Certainly UK, I would blame that on Brexit for many of the European markets, but especially the UK, that had a real significant negative in the fourth quarter, which we're expecting to continue. And very few markets are in this upper right quadrant, where, quite frankly, almost all the markets have been for, throughout the recovery from the GFC. So U.S. being, carried, really responsible for the gains. South Korea also as well. And a few surprises. So Hong Kong, which has been on fire, really stumbled in the fourth quarter. Too soon to say if that's a trend or just a aberration there. Netherlands, which also has been one of the most popular markets in Europe, saw a very weak fourth quarter. So we'll have to see. But the takeaway from this is that while headline numbers are great and relatively positive, lots of variation. Germany, steady Eddie Germany is always kind of where it should be, kind of flat. Australia, same place. So we'll have to keep our eye on these trends. So let me talk about global capital flows for a second. So we're going to introduce a very simple graph. This is just the percentage of all the transactions that we track that we can identify cross-border capital as the ownership. They're either the direct owner or a joint venture partner. When we track cross-border capital flows, it's direct acquisitions. So it does not include indirect investments, such as if some big foreign sovereign puts money into a U.S. equity fund. That's not part of these stats. So if anything, it's underestimated. But it just shows you how global the real estate markets are. So we tracked this is income-producing assets. Almost $1 trillion of transactions last year, and cross-border capital was behind nearly a third of that. And that's basically back to the highest was back in 2007, about 33%. We're at 32% now. Certainly the sources and destinations of all that capital has changed dramatically. This is when we talk about cross-border capital, we can split it into two components. One is global, which is capital that goes from one continent to another, and then continental, so activity, say, within Europe, how we split it out. And you'll see some distinctions of that later on. So where's the capital going? These are the 10 top cities. Each of these 10 top cities had at least $5 billion of cross-border acquisitions over the past year. It's actually a fairly well-distributed group of markets. There are 4 in Europe, there are 3 in the US, and 3 in Asia-Pac. And London, despite its challenges, has always been the top market, and that hasn't changed. Although certainly cross-border investment slowed in the second half of the year. And if I ran it just a bit on that, New York would have surpassed it. But cross-border capital still, particularly in the office sector, is very focused on the top global markets. It's very much a favoritism there. But with these big portfolio deals, and especially much more attention on the logistics space, we're finding foreign capital in many more secondary and tertiary markets in the US and in Europe. Europe did lose a bit of its market share. Europe is, at times had been about 60% of all the cross-border capital were directed towards acquisitions of assets in Europe. Again, a big part of that was, inter-Europe, Germans buying assets, say, in Amsterdam or something like that. And it was down. And again, it's kind of like, all right, pre-Brexit, the referendum, people kind of dismissing it, and the reality starting to set in is my belief. And more capital was directed at North America, particularly the US. A lot of this shift, 2 reasons. Canadians shifted a lot of their capital from Europe back to the US last year. A couple of those big, huge portfolio deals were backed by some of the Canadian pension funds, as well as Chinese and Hong Kong money, which actually really stopped in the US at the end of 2016. Hong Kong money was very strong in Europe in 2017, and then all of it fell a bit this past year. Something to keep your eye on. It doesn't show up in this line, but if I look at the quarterly data, the past couple of quarters, we're starting to see more North American capital and even European capital going back to Asia. So if I had to predict where this would be a year from now, I think this will be up. I think this might flatten out, and this may go slightly lower. I just like this graphic. It just shows how dynamic the capital flows are. You'll be able to get copies of the slide, and you can look at it in more detail. But in the interest of time, I'll just move over. I will say that one thing that's different about this, and one source of capital that isn't appearing in one of these top 20 capital flows, is capital coming out of the Middle East. That is certainly, the curtailment of capital coming out of China has made all the headlines, but the money coming out of the Middle East has actually been just as significant in its decline. So when you look at the sources, U.S. has been top. A lot of it's because of the big equity funds that may take capital from all over the globe are based here. Pretty flat trends in acquisitions on a cross-border basis. Canadians almost doubled, but again, most of that was directed to the U.S. instead of Europe. German capital, cross-border capital, was up 30%. I think there's even stronger demand. Certainly, one factor I kept hearing over and over, I'm sure it'll come up today, is the expensive hedging costs of German investors to the U.S. dollar. And then, of course, you can see Greater China, which includes Hong Kong, down 60%. That's probably the biggest change in the market. And it's also worth noting that South Korea has become a significant player on the global markets, and 5 years ago, not. So this just illustrates the Chinese outbound capital. It peaked in 2017, was significant, and a lot of this was Hong Kong capital to Europe. But then in 2018 we saw, a tremendous slowing across pretty much every theater. As I said, the pullback was felt in the U.S. in 2017, and last year was about flat. If you look at the Chinese have started selling assets, so they are close to, if not net sellers, in the U.S. over the past year. And many of our clients are certainly looking at all the assets held by Chinese investors as potential acquisition targets. And notice we have a number of Germans in the room. German institutional acquisitions, when you count both their domestic activity as well as their cross-border activity, was a record last year that we can capture. And I think that is certainly a trend to watch, and certainly why so many of us in this world are in Frankfurt and Munich and Berlin a lot more than we had been in the past. And then finally, when you look at the U.S., this is shows actually a decade of cross-border capital flows. The levels that we started to hit in 2015 really dwarf what was felt in the market even back in the heyday. Certainly the sources have changed. The orange is capital from Asia, and even though the Chinese have pulled back, it's still significant. South Korean, Singaporean, certainly the Japanese, it's a huge pension fund have just entered the market. It could be kind of another Norges Bank allocation and the wave that hit the market a few years ago. But you can see capital just in the past couple of quarters has started to increase again from Europe, and you can see the significant increase from Canada. Now, so going forward, what do we see? Theoretically, and what you learn in textbooks is capital should flow to markets that give you the best risk-adjusted return. Where cap rates, the spread between cap rates and the risk-free rate, the 10-year government bonds in each of the locales is the highest. That still, I believe, is true. A little bit less so because of the central bank intervention and manipulation to some extent. But if you believe it, and I just still think there's truth in it. It clearly says Germany is going to be still remain a hotspot, a great target destination for cross-border capital. In fact, a lot of the Eurozone in Europe, the U.S. is kind of smack in the middle, but when you look at the economic growth in the U.S. compared to others here, I think that kind of puts it also as, you know, a rich target similar to Germany. So that's about as far as I'm going to make predictions for this coming year, you know, considering how volatile the markets have been. So with that, Richard, I will turn it over and try to keep us on time.
That's super. Thanks very much.
Thank you.